All right. Hi, everybody, and welcome back to our video series called What Your Advisor Isn't Telling You. Today, we're going to be talking very specifically about retirement investing. How does your portfolio differ in retirement than while you were still working? And what we want to focus on today very specifically is a topic that is asked about more than any other when we talk about retirement. And I tend to think that's sometimes a mistake. I often see way too much focus put on the investment portfolio during retirement rather than the other traditional planning, including tax planning, that I think is so important. So before we dive into today's investment conversation, let me just encourage you to go back and listen to our retirement basics video series, where we walk through the different elements of financial planning within retirement and focus specifically on the tax plan. If you've never walked through that example before or seen what tax planning in retirement is like, I encourage you to engage with us on a free retirement analysis that is found at our website, engravewealth.com. We can focus there on the specific elements of a plan for you and incorporate what we're going to be talking about today in our investment conversation. So my question to you would start off by asking this. If you look at your current portfolio in retirement or approaching retirement, can you explain why the most recent investment you made was put into the portfolio? You see, many times when we look at client portfolios in retirement or before, we often find that it is a combination of investment ideas that were hot lately, that were added to a portfolio, and many times are forgotten about. And so over the years, you end up with a discombobulated portfolio of holdings that don't necessarily fit with the current time or risk measurements in the markets. When it comes to building a retirement portfolio, I cannot encourage you enough to think of it like a symphony. There are many different parts to the symphony. You may need more woodwinds, you may need more brass, you might need some strings or percussion to chime in. But the point is simply this, that the best sounding symphony is one that has the appropriate balances of each piece all coming in at the same time together. Folks, if you've ever been to a symphony or an orchestra and heard them warm up before the show begins, it is ear-piercing to hear. But once the conductor steps on the stage and taps the stick on the stand, it comes together in an amazing harmony. That's what your investment portfolio should be like in retirement. So let's begin by thinking about a few common precepts to think about before you go to construct a portfolio for retirement. We like to focus on a strategy called fact-based investing. How do we think about what to put into a portfolio given the current market dynamics? Folks, if you follow what's hot on the TV, or if you're talking about the latest talk show or what's going on the latest blog that you've read about, you're very likely missing some of the most important pieces of what should be in a retirement portfolio. We're going to focus on building a portfolio that makes absolutely no market predictions. We are going to focus on a portfolio that doesn't require markets follow some academic theory of being rational or efficient. We're going to focus on a portfolio that does not necessarily remain fully invested regardless of market circumstances. So how do we know what to put into a portfolio at various times during retirement? Very simple. We're going to focus on the essential elements of supply and demand. And we're going to share with you a way of measuring supply and demand in the market on any given day so that you can know those areas of the market that have the highest levels of risk, or those areas of the market that have the highest opportunity. When we focus on supply and demand, there's a couple of important elements you need to derive from supply and demand. Number one, we like to focus on the first truth, which is that markets historically tend to trend, and they often trend for years at a time. Many times when you look at what's working in the markets, it will often remain that way for an incredible long period of time. Secondly, we often find that areas of performance or underperformance will sometimes persist for extended periods as well. Strength and weakness are more likely to continue in the market than to reverse. Looking at the market through this lens helps us to accomplish two goals in a portfolio. Number one, we get to focus on participating when the markets are working in our favor. But most importantly, we also have the opportunity for protection when markets turn sour. Now, in order to be able to do all of this, you first and foremost must begin with an element of how to know when the markets are experiencing higher risk. And for that, we go back to focusing on the dean of Wall Street, Benjamin Graham, mentor to Warren Buffett, who said the essence of investment management is the management of risk, not the management of returns. We have found that if you can focus on where risk is most prevalent in the markets and avoid it, you can protect your portfolio to be able to participate in better times ahead. So where do we begin? When we look at the global marketplace, how do we know whether to use stocks or bonds, US or non-US, growth or value, large or small? What type of sectors do we use? Folks, all of that begins with a simple view of market risk. If you watched my other video about what your advisor isn't telling you about market risk, you'll recall where this chart comes from. This is a simple reading that we take as a firm daily, looking at markets across the stock, bond, commodity, and other markets to be able to understand where risk levels are most elevated and where opportunities in the market are most prime. By looking at these elements, we can begin to understand, is this a good time to own stocks or bonds? Is this a good time to have commodities? Is this a good time to be looking at various areas of the market on a short, intermediate, or long-term basis? Go back and watch the market risk video so that you can understand better how these elements help us to know how much exposure we want in all of the various categories within an investment portfolio. Now, we use these same tools when we start taking measurements, not just for the broader stock market, as we do with our market indicators, but we can do the exact same thing when it comes to building out a portfolio by studying the demand and risk characteristics of individual asset classes in the market as well. On any given day, we take 7 different measures of risk and we apply them to the various asset classes like large companies, small companies, mid-sized companies, growth companies, value companies, and even to the different market sectors as they apply to stocks. You can do the exact same thing with bonds and commodities as well to better understand which areas of the market have the highest levels of risk that need to be avoided versus those areas of the market that have lower risk and opportunities for better return. As we study and rank the various asset classes, we want to concentrate portfolio holdings in those areas that have the lowest risk ratings combined with the greatest opportunities for demand. Those are the areas in green on the chart as of the date that we took these readings. Looking at those areas, that's where we want to concentrate portfolio holdings. Whereas those asset classes at the bottom of the page in the red are currently those asset classes or sectors that are showing the highest risk levels. Folks, these will change from time to time, but if you go back to our 2 market truths, in the way that market performance tends to persist and trends will continue, it's easy to see that these types of readings tend to persist for an extended period as well. For example, many of the sectors in the red have been in the red for the last 4 to 7 months, whereas those areas that are currently in the green have consistently shown lower risk and greater demand over the last 6 to 12 months. Folks, that allows us to build a portfolio that does not involve a lot of in and out trading. It doesn't create all sorts of looking for new ideas. But what it gives us is the opportunity to simply build a portfolio out of those areas of the market with the lowest risk and the highest opportunity for return. Now, having said that, are we simply going to equally weight all of the different asset classes in the green? And we certainly wouldn't want to do that because that does not regard your personal risk profile. Looking at your own personal risk profile and understanding how comfortable you are with risk is going to help you fall somewhere on the spectrum of our allocation models. For example, many clients will simply look at the models to determine, I'm not comfortable taking that much risk, or I like the idea of taking that much risk. But this goes a little bit deeper than simply categorizing yourself as risk or no risk. What we also want to do is dive into your personal situation a bit to know which accounts you have that might be able to afford more risk, while other accounts need to be accounted for with less risk. For example, if you follow the bucket investment strategy in retirement, there is always going to be a bucket that is there to provide the current income needs you're going to have for the next 2 to 3 years. Well, I would put forth that that's a bucket you don't want to take a lot of risk with. That's a bucket that needs to be somewhat protective. And therefore, that investment bucket probably needs to be lower to the left on this screen, whereas a Roth IRA that is probably invested for a much longer term horizon could be invested further to the right and higher on this screen. Folks, everyone is going to have their own personal comfort level with risk, but don't stop there. Dive a little deeper to think about which parts of the portfolio can afford to take a bit more risk and which areas need to be a bit more protected. Now, the key question that I've avoided so far, but I'm not going to avoid it completely, is how do you literally go about choosing individual investments in a portfolio? Folks, I'm glad you asked. When it comes to selecting investment ideas, we're going to apply the same basic premise of understanding risk and return. The first place to start when it comes to actually constructing a portfolio are going to be those asset classes or sectors that have the greatest strength. So if I zero in on just those areas of the market that have shown me the lowest risk with the greatest opportunity for demand, and then I begin to apply some basic risk return studies on the various categories. So for example, in this category, I'm going to pick out the mid-cap value category, which is showing outstanding risk levels right now for the returns we're able to get. And from that, I want to consider all investment options. Now, many people ask, well, what do you prefer? Individual stocks, mutual funds, index funds, ETFs? Folks, at the end of the day, I'm completely agnostic to the vehicle as long as I can understand better the return and risk element of each one. So for example, if I can go through and study to try to understand of all of the different stocks, mutual funds, index funds, and ETFs in the mid-cap value space and look at their individual risk return characteristics, I can get a much better idea as to which investment vehicles will tend to outperform over time. Some of those return and risk elements that we study are things like Sharpe ratios, alpha, beta, standard deviation, Trainer ratios, upside, downside capture, and information ratios. All of those vehicles together are going to help us to see which investment option gives us the best opportunity to get handsome returns at lower risk levels. Folks, this is an investment process that becomes extremely important as you get closer to your retirement years. And if your advisor is not using something like this in your portfolio in retirement, I would seriously question how they build portfolios. Portfolio construction is probably the most important piece of thinking about generating retirement income while still getting retirement growth. Thinking about how a portfolio is constructed is extremely important no matter what stage of the game you're in. And after experiencing a negative year in the stock market, now's the perfect time to think about it. Folks, if you've never been through an exercise like this, if you've never looked at what this is, I want to explain how Engrave Wealth goes about this process and why it is we look a little bit different. We learned a long time ago that focusing on retirement creates a lot of anxiety. And when it comes to individuals thinking about retirement, we knew that that level of stress is something that needs to be dealt with in a structured way. So we created a commission-free fiduciary planning process that is designed to help you minimize the amount of taxes that you pay in your retirement years. Focus on getting the income that you need after retirement, even if the income in the early years might be a little bit more than the later years. And finally, how to protect your investments from market downturns. Folks, these are important elements when it comes to building out that plan for retirement. And if you've never thought about that plan in its entirety or in the big picture, I strongly encourage you to begin asking some questions. Does my portfolio carry too much investment risk right now? And how much am I paying in commissions and fees to build this overall portfolio, especially the hidden fees? Folks, how do you think about considering tax optimization like Roth conversions or NUA? And what is my tax liability going to look like when I turn 72 and have to start paying those RMDs? All of these questions can be answered in a simple retirement optimization process. Folks, looking at retirement optimization is all about looking at your current situation, focusing on things like last year's tax return, existing account statements, and from that, we can build out an analysis that helps you to look at the tax picture, the income that you're able to get, how much risk you're taking, and put it into one simple free analysis. Folks, that analysis is something we do not charge for. There's no obligation or contracts to sign. We're happy to build the analysis for you. It usually takes about 1 to 2 business days to put together, and then we'll schedule time to visit with you via Zoom or in our offices in the Woodlands, Texas. Folks, this is an important process that if you've not built or not reviewed lately, I cannot encourage you enough to go into our website at engravewealth.com. Start the process now by clicking the button that says Start Your Free Retirement Analysis. Folks, I hope this is helpful. I encourage you to run the free analysis and stay tuned to our other videos about market risk, portfolio construction, and retirement taxes so that you can better know how to handle your retirement. Folks, thanks for your time today. We look forward to working with you and engaging with you on the free retirement analysis. Feel free to hit that button, engage with us now, and we'll look forward to talking soon.